The FTSE 100 is made up of the top market cap companies on the London Stock Exchange. Today we'll be going through every single one of them that pay a dividend, starting off with Astrazeneca, working our way down. So without further ado, let's get right into it. Now, AstraZeneca, massive pharmaceutical company. A lot of you may be familiar with the Oxford AstraZeneca vaccine that came out for COVID. Now, they are up 38% and they pay a dividend of about 1.71%. Last share price was £113 per share and a massive market cap of over 175 billion. At the moment, they are hedging their bets on massive future growth as they have quite a few drugs in development, and obviously the manufacturing that into the future is going to be worth an awful lot. Health, dividend value and past on their snowflake isn't too bad. It's pretty acceptable. And a few of the problems, they have a high level of debt, although that's quite common among an awful lot of pharmaceutical companies, and nothing really out of the blue. So let's jump down to future growth. Currently forecasted at nearly 29%. As you can see from the start of the pandemic, earnings and revenue, well, revenue at least has nearly doubled, and they have got their earnings almost at about 2 billion per year. Free cash flow is where AstraZeneca shines through. They have almost, as of today, nearly 6.5 billion in free cash flow. Very impressive. Now, let's jump down to their financial health. At the moment, 20 billion to 24 billion in the short term, and then long term, they have an awful lot of long-term assets. We can go down here and it gives a wee bit of a breakdown. Nearly 10 billion in receivables, 9 billion in physical assets, and as you can see, an awful lot in cash, which a lot of people love to see. Their debt is also covered by their operating cash flow as well as interest payments. Onto their dividend, it's currently 1.71% as of a yield, and it's pretty stable and good cash flow coverage. Everything else, it's not very notable, it's not very high, and currently it's not growing. It's actually been very consistent. From 2013, their dividend per share did not move whilst their yield slowly declined. That's obviously due to their share price going through the roof. They actually dropped their dividend per share in the last payout, which is interesting to see, and their yield has been steadily dropping, but they reckon into the future that it will grow. Okay, so drop down to ownership. I always love to just pass through and see top owners: BlackRock, Capital Research and Management Company, and T. Rowe Price Group. Okay, who is next? None other than SHEL. Massive oil giant, energy and petrochemical company operating across the world. Now, on their snowflake analysis, they seem to be very, very healthy, as with most oil companies. Past performance is also really, really good. Futures, where it gets a bit iffy for many of these giants. Will it run out of steam with the way oil prices are going? Well, oil prices could come collapsing down, and that will affect them. Oil, gas. The energy market itself is nearing an all-time high, and that is something to at least be take note of. We have valuation 3 out of 6, and dividend also 3 out of 6. Earnings are forecast to decline over the next 3 years, and they have an unstable dividend track record. Yeah, so in the future growth, it appears that they are forecast to actually go down, being again, at an almost all-time high. We can go down to past performance, and back in 2018, things were also looking pretty good, as they are here in September. Had a wee bit of a dip over COVID, but have recovered since. Financial health, you can see short-term covers their liabilities pretty well, and long-term is also the same. Debt-to-equity ratio, they're sitting currently at about 29%, which is good to see. Debt's all covered, and interest payments as well. Sitting with over $36 billion in short-term investments in cash. Now, their dividend is where they shine through at 3.56%. It's a very notable dividend, and it was very consistent up until 2020. Then it was cut, and it seems to be rising, forecasted to continue to do so. Now, let's jump down here to their ownership, and we'll see who owns a good bit of them. Topping it off with BlackRock, Vanguard, and Norges Bank Investment Management. Cool. Right, let's jump over to the third one, which is none other than Unilever, a massive consumer goods company, which they're snowflake, they're okay value, pretty good dividend, and everything else isn't too notable, pretty average. High level of debt and an unstable dividend record, but earnings are forecast to grow. So let's go down to their future growth. Currently sits at 9%. They seem to be very optimistic towards it. That's pretty good. Okay, past performance, -4%. They've had better years compared to now. Profit earnings-wise, they seem to do pretty well in 2018 and 2020. Financial health, they aren't doing super fantastic in the short term, but long term their assets cover their long term liabilities, and they seem to be steadily creeping up in both debt and equity. So something to take note. But their debt coverage is pretty well covered by operating cash flow, as is their interest payments. Okay, down to dividend, 3.38%. Okay. And it has been growing. They have consistently grown their dividend for what appears to be at least the last decade, which is good to see. It looks like it took a wee bit of a lull into 2022, but that can be excused most of the time due to, global pandemic. Alright, ownership is something I always love to gloss by. BlackRock, Vanguard, and Lever Hummel, trade charities. Okay. If you want to know what products they own, I'm sure a lot of you will be familiar with Unilever's products, such as Dove, Ben & Jerry's, Magnum's, Domestos, Hellmann's Mayo, one of my favourites, Sif, Lynx, and many, many more. Okay, on to the next one, ticker symbol HSBA, HSBC. So, they are a massive bank and financial services giant. Market cap of almost 100 billion, trading at £4.96, up 13% over the last year. Their value value's pretty good, future growth, everything's looking up, and they're pretty solid when it comes to financial health, as is most financial services. Unstable dividend track record and a few other things of note. Let's go to future growth. Currently sitting at 14%. Not too bad, and forecasted to grow into the future. Nice. Had a wee bit of a lull over 2020, which can be excused, pandemic. Let's see, past performance. Again, you can see the wee drop over the pandemic. Free cash flow, notable sometimes, notable, yeah. Okay, that chart didn't help me out too much. Let's go to financial health instead. Assets of 1.3 trillion to 2.34 in the short term, and long term, it's looking a wee bit better. Now, whilst their debt-to-equity ratio does look a little scary for banks, that's not too much of a problem. As you can see, most of the loan levels, low-risk deposits, all that seems to be pretty much in the green and not too bad. Okay, dividend, 4.42%. That's pretty respectable. It's not very stable, as you're about to see. It was very consistent, at least from 2013 all the way to 2019, obviously dropping off in the pandemic and rising a wee bit since to about 4.4% and as of right now. Down to ownership, who owns most of HSBC? Pingen Assets Management, followed by BlackRock, followed by Vanguard. Okay, on to our last one. And last but not least, we have Diageo. They are the owners of many, many beverages that I'm sure a lot of you will be very familiar with. Trading at £37, they're down 5% over the last year. They've had, it seems to fluctuate between £40 and £33 as of, the past year. Now, they pay a reliable dividend, one of the more reliable payers in the FTSE 100. High level of debt, earnings grew quite nicely over the past year, and they are forecast to continue growing. As you can see from their snowflake, they have a proven track record as an established dividend payer. Financial health, not too bad. Past performance, good. Future, looks alright. Value's the only thing they don't score too good in. Now it's jumped down to future growth, 9%. Forecasted to grow pretty nicely over the next couple of years. Now, I take obviously that with a grain of salt, but something to look into. Free cash flow, also very nice. Down to past performance, we can see the wee lull that they had over the pandemic, and they seem to have recovered their profit margin to about 20%. Financial health, things are looking pretty decent for them. We can see that their debt has grown, but is well covered by operating cash flow, and interest payments are also covered. They are sitting with about £2.4 billion in cash and short-term loans. Very, very large inventory, and quite nice in the receivable end. Down to 2% dividend yield. It's notable, not very high. It's stable though, growing and covered by both earnings and cash flow. Yeah, the dividend per share, the light blue chart, very nice, growing over the past, at least the last decade. In 2015, it's at about 3.1% yield. Obviously, the yield's dropping as their share price continues to grow, but seeing a dividend per share growth is fantastic. Down to ownership, let's see who owns an awful lot of Diageo. BlackRock, Massachusetts Financial Services, and Vanguard, respectively. Okay, on to the last bit, their products range. Always love to show off if I can see it. We've got Ciroc, we have Johnnie Walker Black Label, we've also got Captain Morgan's, Bailey's, Guinness, a lot of these you'll be very familiar with, one of my favourite drinks. And then we have Smirnoff and a few other ones. They own an awful lot more brands than this. It's just a few for you to see. And that has been, let's jump all the way back to this. Huzzah. Okay, so we've covered the top 5 market cap. In the next episode, we will see BP, British American Tobacco, Rio Tinto, Glencore, and GSK. I will be doing deep dives individually into all these companies, but for now, I just want a quick blast through the 100 so you can get at least a quick reference using Simply Wall Street. Catch us all in the next one. Thank you.